Hi, my good friends. We are all welcome once again to this segment of advanced financial reporting. Let me not say advanced. It's advanced anyway, but from our context, we are saying financial accounting 3. It's an advanced accounting topic we are dealing with. Okay. So you find it typically from the core text, chapter 11. That's page 229 of the current edition. Yes. So that's the one we use in chapter 11. Whether you're using the current or the previous edition is still chapter 11, revenue. Okay. So our presentation is typically centered on that one. Once again, friends, I know sometimes when you watch the videos, it appears to be quite straightforward. You look at the questions and it looks like it's a bit different. It's not. It's only pushing us outside our thinking box, our comfort zones. They want us to think extra. Okay, that's accounting, that's practice. Because in the world of accounting, things change. Okay, I'm going to be teaching you simple revenue, the 5-step model approach, and how to recognize revenue. It looks easy on paper, but in reality, when you get to the workplace, you realize that it is equally easy, but it's technical. Okay, so what we are doing in this model is such that it's technical. There's not anyone at all who can do it. That's why you are a specific, unique group. You are a special group who is supposed to be taught this. Not anyone, no, not an engineer. It's an accounting course, okay? So you'll be fine. There's nothing difficult about it. There's nothing difficult. Look at the tutorial question and you realize that it's just challenging you to think outside your thinking cap, okay? Put on your thinking cap and think outside of it and you'll be fine, okay? Once again, we'll try to keep it brief and split them into 2 or 3 sessions depending on how fast and how easy we sail through. So we'll keep it brief. All right. So IFRS 15. Gradually we are moving, right? We are on week 5 and we'll finish soon. Okay. So at the end of this session, we want you to be able to understand the 5-step model that relates to revenue recognition, okay, and measurement and reporting. Especially we're dealing with revenue earned from a contract with the customer, okay. So the same thing happens when, for example, you work with a company like EE or Vodafone or Virgin Media, where they give phone contracts to people. Okay, the revenue they gain from the phone contracts which they give out to customers falls under this. Okay, it's a form of it falls under this actually. It's not a form. So you see one of our question under the tutorial question 1 under A. I've tagged them as A, B, and C. The A question 1 deals with similar item. Okay. And then we're talking of after at the end of the day, we should explain the revenue recognition criteria where performance obligations are satisfied over a period of time or satisfied at a point in time. 2 things. Okay, where performance obligations are satisfied over a stretch of time and where it is satisfied or met at a time, at a given time. We'll also look at any acceptable methods of measuring progress, okay, towards performance obligations satisfaction. And then we also look at some other dimensions of revenue, bill and hold, sale and repurchase, principal agent, okay. The acceptable methods, we're looking at input, output method, very easy to calculate, okay. All right, so overall, this is an overview of the picture we have just to illustrate the revenue recognition model or process. So 5-step approach, this is what we'll be looking at, okay. And we want to use a terminology. So we use a COPA, the COPA approach, okay. We'll look at it. So, and then we'll look at specific transactions at a certain time, okay, at a time, and where we satisfy it over time. And then how do we measure progress and present this on the face of the financial statement? The key thing over here is that remember your debits, okay, and credits. That's a key thing I want you to remember. Your debits and your credits. Usually, when you take the tutorial questions, you realize that we are testing you on angles that cover revenue recognition, the debits and credits. So, of course, you will surely have some cost of sales, okay, which will match with some inventory. Okay, let me say you'll be looking at being examined on cost of sales, inventory, areas where you know what do I debit, what do I credit, okay. Then the debtors, sometimes these guys will buy or will pay us later. We give them the assets and they pay later, okay. And then sometimes cash, okay, and of course overall revenue, okay. There's a liability component we need to also look at. Okay, there's a liability component. You ask me, this is about revenue. Why liability? Okay. What if you get some money? You are yet to deliver the product. You've taken the money. What do you think comes to mind over there? Okay, we'll look at this. Okay. Because at the end of the day, if you are not able to deliver, you owe that person. It's a liability. You pay. We take a typical look and you will understand. Okay. It's so interesting to know that revenue recognition has evolved over time. Okay. Gone were the days we had IAS 11, construction contracts. IAS 18, typically that was what was covering revenue. And then we have the IFRS 13, 15, and 18, which deals with some elements of revenue, customer loyalty programs, agreements for real estate construction, okay, transfer of assets from customers. And then the 31, which deals with barter transactions, including advertising services. But these all have been knocked off and superseded by IFRS 15, revenue from contract with customers. So currently, this is where we are more interested in. The 5-step approach covers this, but we'll take them one step at a time. We'll take illustrated examples under each step, okay, and then we'll try to understand what each step means. At the end of the day in the exams, if for example you are given a typical scenario and you are asked to apply the 5-step model, this is a typical exam scenario where we normally want you to understand the 5-step model. It's enough to cover everything. At least that will give you a fair idea and an understanding of how to apply the principles under IFRS 15. In the workplace, you will surely meet a senior colleague there who has been working on revenue recognition. He will teach you. Okay? It's easy. We have models, we have softwares which will guide you on how to recognize this. It's easy. So for now, it will be better that we will also understand the model, the procedure, the process that we take to recognize, measure, and capture or present revenue on the face of the account. That's a key thing I want you to understand and to grasp. The calculations will flow. They are easy. Okay, but get the model. And that is enough for this. Okay, so the copper, I highlighted them in red. Okay, identify the contract with the customer. Identify the performance obligations. What do I need to do? Is there a written contract? What do I need to do? What is the price that is to be paid, the consideration or the debt from the other side? Okay. Then at the end of the day, once I know the price, I allocate the price reasonably and then I recognize it once I know that the obligation has been satisfied, whether over time or at a time. Okay, we then recognize it. So one step at a time, once more, the COPA, identify the contract. We take that one. And then we'll come to identify the obligations, the separate performance obligations. We'll determine the price. We'll calculate, we'll find the price, okay? And then we allocate the price reasonably to the obligations. And once they have been satisfied, we recognize revenue, okay? So step number 1, before we move in, step number 1, let's start. Step number 1 says that, listen, revenue from contract with customers requires that there should be an agreement. Usually it is a written agreement between two parties where one person has the right to claim something from the other party and the other person has the obligation to deliver or to provide to someone. When an obligation is placed on you, it's like you have a duty of care to discharge something, to construct a road, okay, to produce an asset and give to a customer. That's the obligation on you. The other person on the receiving end has the right to claim those assets which you are producing, manufacturing to them. Okay. So it is stated that an entity can only account for revenue from contract if it meets these criteria. One, the parties on both ends with the rights, the one with the right, the one with the obligation, they've approved the contract and they've clearly identified each party's rights and obligations. Okay, that's the first thing. It's like a normal contract law of contract, where we know that we will sign a contract. I know what I'm supposed to deliver. I know what I'm expected to claim from the contract. The second criteria is that one, that two, payment terms must be identified. Be sure. How will the payment terms be made? Today, you pay some cash, later you pay portion, or all is deferred. Okay. So try to establish the payment terms. And then the contract should have a commercial substance. We're talking of cash. We're not talking of abstract. Even if I'm gonna give you the asset and you will not pay me cash and you will give me shares. The shares have commercial substance. Okay. So it's not like I produce this cap for you. I give it to you and you say thank you and move away. No. There should be some commercial substance in the contract. Okay. And then also finally, it should be probable that the selling entity will receive some consideration. It's not for free. It's not for a thank you. I produce and give it to you and you tell me thank you. No. You got to pay something. So I'm expecting something to take from you. For example, if I'm an agency and I produce staff to the university, I expect that the university will give me some cash as consideration. Okay, that's revenue, that's the income. Even if you pick it as a standalone person, I work with the university. There's a contract between myself and the university. My right is that I'm expected to claim some money after I have met the obligation of satisfactorily lecturing every month and doing all my administrative duties and academic duties. The obligation on the part of the university is to ensure that they pay me at the end of the month. Okay, terms have been established, payment terms have been clearly stated that on 25th or 28th, you'll be getting this sum of money with some increments every year. Okay, that is the commercial substance. There's cash involved. Okay, and I'm always anticipating that at the end of the year, I should get that cash amount from the university. It's a contract from customers, revenue. Okay, so you could also flip it on the other side in terms of producing a tangible asset to give to someone. That's what we'll be dealing with. We'll assume that it's more of a tangible. Of course, you can apply it to a service scenario as well. So take a typical example in terms of the step one. Identify the contract, the C in COPA. So Alma has a year end of 31st December 2021. On 30th September, 3 months, that's 3 months to the year end, Alma signed a contract with a customer. Within the contract, Alma said, I'll provide you with an asset on my year end, 31st December. Control of the asset will pass to the customer on 31st December. And it is expected that the customer will pay us 6 months later, 1 million. Okay? On the 1st December, what do you see? We realize that as a result of change in economic climate, Alma did not believe that it was probable that it could collect the consideration that it was entitled to. COVID has struck. Things have gone haywire. They've delivered perhaps almost, or yes, they've delivered. But by the look of things, the company cannot pay that 1 million. Okay. Here we are saying that, listen, given that it is probable that we cannot collect the consideration we're entitled to, we say that contract cannot be accounted for and no revenue should be recognized. So ensure that all these four are met in the contract. Okay. So once they've established that we cannot claim the money because these guys have gone bust, what do we do? You cannot recognize revenue. Okay. All right. Number two, step two. What are the obligations within the contract? Okay. So IFRS 15 says that, listen, we should have distinct performance obligations, clear cut. You are the lecturer, you come in to teach, you lecture, you be the module coordinator, you mark scripts, clear cut obligations. On the other hand, the other person is saying, I'm going to pay you this amount. Clear-cut obligations, okay? So the obligations here are typically talking of performance obligations, actually, are talking of promises to transfer some distinct goods or services to the customer. In this case, if it's a lecturer who is teaching, the customers are the students. In fact, the university is even the customer to the lecturer. Okay. Now, there may be more than one performance obligation within a contract. Okay. I'm saying the university is a customer because at the end of the day, you don't teach the students or lecture the students and go to them and say, pay me. The students don't pay you. The university pays you. So the university is actually the customer to the lecturer. The students are the customers to the university. Okay. It's the other way around. Okay, so here we're looking at performance obligation 1. I want to supply you these goods. That's my performance obligation. The second one, I'll provide you with some after sales service. That's also another performance obligation. Clearly distinguish this and identify it. Okay. Let's take an example, illustration. So an entity enters into a contract with a customer to sell a car. We'll give you the car and we'll also provide you after sales maintenance, free maintenance for a year. Now, the sale of a car is one part of the performance obligation. The provision of the maintenance, the annual free maintenance servicing, after sales servicing, is another part of the performance obligation. They are not interlinked, they are distinct. And mostly you see in questions where they state that the customer does not provide or does not sell the services separately. Okay, so but they are all distinct. You see that they all have their different phases. Okay, then we account for the different phases in a beautiful way. We'll look at examples and we'll see. Okay, so that's it, the performance obligation. So we finish with the contract obligations. Okay, let's go to the P, the price. Now we must determine the price. We'll spend a little time here, and I think we'll end it here, and we'll continue with the next session. Just watching my time. Now, the transaction price is talking about the consideration that the provider, the one who is providing the obligation, is expected to receive from the one who is claiming the right to those assets. Now, over here, the entity must only, the seller, okay, the seller or the provider can only be entitled to this price once he's met all the performance obligations in the contract. If I absent myself from the university, I'm not teaching, I'm not lecturing. Do I expect to get some salary at the end of the month? No. The university will not pay you. So for me, who is providing the service to the university, I must ensure I have met all the performance obligations within the contract of performance that was given to me by the university. Now, there are a number of issues we need to consider here, and we'll take them step by step, after which, like I said, I'll bring it to a pause. Then we'll continue with the step 4, okay? You could obtain a variable consideration. What is it? What does it mean? You could also get financing. What does it mean? Financing. What comes to mind? Okay? And then we could also have consideration payable to a customer. How possible? I'm giving you goods and services, and I'm also paying you some money. How possible? What is happening? Then we could also give you non-cash consideration. I give you the goods, the services. You don't pay me cash. You pay me something else. What do you pay me with? Is it cash? Is it shares or an asset in return for an asset? Okay. We'll take them one after the other. So IFRS 15 says that, listen, if there's a contract and it includes a variable consideration, then we must estimate the amount we expect to receive, because we are not too sure. It's not a fixed amount that I get 2,000, but it's a variable. Okay. But it will also include such value within the transaction price if the likelihood of payment is highly probable. So what is happening is, for example, I'm supposed to construct the road and get some money. But there are some clauses, caveats, that if I do not complete it on time, by 31st December is expected by the contract, obligation set. If I'm not able to finish it by 31st December, I'll pay penalty. We need to look at that, okay? As the seller, the one who is providing the service. On the other hand, you are being told that finish it early and you get bonus extra. Okay, so all of these must be factored in. We must estimate them reliably. Okay, but we are being told that we should only include them, the bonus that we get for completing the work early, for providing you with the goods and services early, or the penalty we incur for not meeting the deadlines. We must include such values within the transaction price, provided there's a high probability that it will occur. Those things will occur. All right. Financing comes to mind. When we talk of financing, it's like going for a loan. When you go for a loan or going for a bond, going for some equities, financing, that's what we know. Finance. And we know that once that happens, what happens? When you go for a loan, you pay interest. You go for shares. Somebody gives you money to run you pay some interest, cost of capital. Okay. Even go for bonds, you pay some coupon rates. Cost of debt is there. Okay. So in terms of financing, we are saying that when there's a significant financing component existing within the contract, when there is a substantial delay between the customer receiving the goods and the services, or the customer paying for those goods and services, even if this has been advertised as interest-free, we need to consider the interest component of it, time value of money. Okay, so it happens that sometimes we decide to submit, we do the work today, but we take the payments later, deferred payments. Okay, now in these, the consideration receivable needs to be discounted to the present value at the rate at which the customer is able to borrow. So I'm doing this for you. I'm providing you with the service. You tell me you pay me 5 years later. What do you mean when you're giving me 5 years, 1 million, and 5 years later? 1 million, 5 years is not the same as today. So I need to discount the 1 million from 5 years up to date. At what cost? At the cost of capital, the cost or the rate at which the customer can borrow. It's like you are giving the customer a loan. Okay, you are giving him a loan and he will pay you later. I'm teaching for the university. The university says, listen, we'll pay you after 7 months. Do you think the money they pay me 7 months the same as today? No. There's a financing component there. They are taking something for not for free, okay, for credit. And so they have to pay interest on it. Okay, that's what we are saying. So at this point, we need to discount it to the present value. We take an example you understand. Okay. Again, we can also provide these elements or these assets, the contracts, and will not get cash. Sometimes you provide the goods and services and they give you shares in the company. But these shares must not be valued at the par value or at the original face value. They must be valued at the current market price, fair value. Okay. So if at the par value it was £1 or $1 per share, and currently the market value is let's say 2.5 pounds or dollars per share. That is what we need to value to get the current scenario. Okay. And then the fourth one, like I said, you producing the goods to the customer and you have to pay something. You pay money to the customer. What comes to mind here? Normally, what we normally see here is a matter of discount. Okay, it's more of a discount. So if consideration is paid to the customer in exchange for a distinct good or service, then it should be counted for separately under the purchase transaction. Okay, it should be accounted for as a separate purchase transaction. Now, let's assume that the consideration is paid to a customer. Assume that the consideration paid to a customer is not in exchange for distinct goods or services. Then the seller should account for it as a reduction in the transaction price. Okay, discounting comes in here. Okay, before we end, we take this example and use it to cover the elements of the transaction price determination, the variable price, or variable consideration, the financing, and then the discounting element we've looked at. Okay, the non-cash, and then the element of paying consideration to the customer. Golden Gate enters into a contract with a major chain of retail stores. The customer commits to buy. The customer says that I'm going to buy at least 20 million worth of products within the next 12 months. That's a good deal. The terms of the contract requires Golden Gate to make a payment of 1 million to compensate the customer for changes that it would need to make to its retail stores to accommodate the product. So we're giving you are going to buy items 20 million, but we said, hey, listen, we want to give you 1 million because once you are claiming or taking these products, you are supposed to adjust your retail stores to modify your warehousing to accommodate these products. So we're giving you 1 million, a consideration paid to the customer for a distinct service. Okay. But assuming you cannot identify clearly, we are giving you 1 million to compensate you for nothing. No statement is made here. So we just say we're giving you 1 million, no compensation, nothing is mentioned here. Then we treat this as a discount. We treat this as a discount of this, okay, telling you that we've actually given this guy 1 million out of the 20. Now, by 31st December 2021, Golden Gate has transferred products with a sales value of 4 million. Okay. We said we wanted to buy at least, the customer wants to get 20 million worth over the next 12 months. But at the end of the day, we realized that we couldn't supply that much. We are supplied 4 million. Okay. Either way, it looks like a discount. Whether this guy is getting everything or not, per the deal, he would have gotten a discount of 1 million out of the 20, right? How much revenue should be recognized by Golden Gate? We couldn't meet the 20. If it was 20, we would have given him 1. We only supplied 4. Should we still give him 1, or we should prorate it proportionately? Logically, somebody will pick that. Well, if 20 is to 1, 4 will be what? Easily, okay? But let's see. Per our accounting, like I'm saying, the payment is made to the customer. It's not in exchange for a distinct good or service. We are giving him 1 million, more or less, because it's going to expand something. Either way, it is more like a reduction in the price. Okay. Now that this guy did not buy the 20 million, what will happen to his shop, the retail stores? Will he still modify it? Maybe partially, maybe not. Either way, we are telling you that because you are buying more, we'll give you this amount. It's a discount, okay? So the total price that we are giving this guy, this 20 million, okay, it's actually reducing by what? 1 million. So we should have given this guy 19. So in reality, we would express the 1 million as a percentage of the 20 million to see the percentage that we would have applied in terms of discount, which is 5%. So it is logical that if we couldn't supply the 20 to give him 1 million, let's prorate it. We gave him 4 million. So what should we grant him in terms of consideration we pay to him? Okay. So we need to reduce whatever price by 5 million. So the 4 million should now be discounted downwards by 5%. So instead, we're just going to find 95% because it is 100% minus the 5%, which gives us 95%. So it will be 95% of the total 4 million we supplied to him, which gives us a value of 3.8 million. So this is what we should recognize in our books. This is what we should recognize. Again, let me take you one step. Either way, assuming we were giving it to him for some specific goods or service, here this question looks a bit confusing. Let me put it that way. Because to compensate him, because he's going to make changes to his retail stores to accommodate the product. Is it because of the purchase of this product? That's why he's going to make these changes? Or he was already in the process of making these changes to accommodate the sale? One could be before the touch, after the touch, okay? But either way, we see that this guy is not really giving us a service in return. Okay, that's what we are saying. He's not giving the seller a service in return. Instead, he's just using it to modify his own premises. So nothing much coming to the seller. So let's consider that it's more like a discount, okay? Somebody would also argue that if not for the fact that he's purchasing this, he wouldn't have redesigned his retail stores. Therefore, it's a form of distinct service he's providing, but still the question is not to the seller, but to his own self. Okay, to himself. All right. So that's what we would have recognized in the books. Okay, we recognize this. So we end up crediting our revenue. Okay, and either debiting our cash or bank. Okay, assuming he paid. If he did not, then we would have debited what our trade debtors. If he paid later, if he's owing, and then the corresponding we credit our revenue. Okay. All right, easy. Let's move on. So the financing element. Okay, time is gone. But let's take an example of the financing element, then we move on. It's very important for me to look at this. Okay, we'll get there. We'll get there. Okay, I'm gonna stop here. I'll stop here because if I look at my time, it's far gone. I'll stop here and I'll come back to the financing element. The financing element because there are some calculations we need to look at over there. All right, so friends, I will end here for the first bit and then we'll continue with the second bit. All right. Now my screen is frozen. Screen is frozen. All right. So my screen froze for some few seconds. If you should see that in the video, don't be worried. It was just a frozen screen. All right. I'll end here. I'll see you in the next piece. Bye.